All right, everybody. Welcome to Financial Fridays. This is a partnership between Visions Federal Credit Union and the Library System of Bradford County. We are doing this because we wanted to give everyone access to really basic and then build on that advice on how to deal with money matters that a lot of people might find confusing or difficult or just need a little more input on. So today we're going to talk about credit scores, all those fun things, how they affect everyone. Matt Kozlowski from Visions Federal Credit Union is our good friend and our savvy presenter, and he's going to keep us informed today. Matt, are you ready?
Absolutely. Thanks so much, Leah, and thanks everyone for joining us. Thank you for having me. And before we start and really dive into the crash course in credit, which is a really broad overview of credit, I want to let everybody know if there are questions throughout, you're more than welcome to throw them in the chat. Otherwise, feel free to unmute yourself, interrupt me. I don't mind a bit, because this really is that basic overview of credit that we're going to touch on a lot of things. And if there are topics that you would like to dive into deeper, we can absolutely do that, because we want everybody to get the correct things out of this presentation. We want to really dive into the factors that you want to focus on. So when we're looking at credit as a whole, it's really difficult to overstate the impact that credit has on your financial life. And it goes beyond just wanting to secure loans. It really is a factor and something that needs to be strong in order to do things like secure a cell phone plan or rent an apartment. There are a lot of different people that are going to want to check your credit, make sure that you are a trustworthy borrower or somebody that they can trust when there are finances involved. So to get started, we need to know the difference between credit reports and credit scores, because these are things that you're going to hear a lot. So there are differences. We got a question in the chat here. Oh, no, that's just Leah tossing that in there. Awesome. Giving the advice, feel free to unmute yourself, toss them in the chat, however you like. But back to credit reports and credit scores. These are things that can get confused, because you think, okay, I got my credit score, that's the end of the deal. But really what the credit score is, it's made up of factors that you find on your credit report. So the credit report is an organized list of the information related to your credit activity. So on there, we're going to dive a little bit deeper into reports soon, but on there, you're going to find every single account that you have open, your loan account, how much you owe on it, what the monthly payment is, if you've been making those payments on time, and other information along the way. Credit scores are the result of a mathematical calculation assigned to a person that indicates how likely they are to pay their bills in the future based on information on their credit report. So really it's an assessment of how risky of a borrower you are. And now credit scores range from 300 to 850, and the higher you have as far as credit score, the better. The goal really is to breach that 700 number, 700 plus. So on the credit report, a lot of times the question is, well, what's on that? So we mentioned a couple things. You're going to find a list of your credit lines or loans. So every single thing that you have open there, the balances and credit limits. So if you have a credit card that has a $10,000 limit, the credit report's going to show that. And it's also going to show the balance on that. So if you have a $3,000 balance on a $10,000 card, the credit report's going to show that exactly how much you owe. And it's also going to show the minimum monthly payment. So your payment history will be on there as well. If you're late, on time, anything like that, if you missed a payment completely, but it will show you how many are 30 days late, how many 60 days late, and then there's 90 plus days late. How many inquiries you have. So that means how much are you going in and trying to, secure loans. So if somebody goes around to 5 different banks, applies for loans, those are going to get reported back to the credit bureaus, and it's going to show in your report that you went 5 different places applying for loans. So those 5 inquiries are going to show up. And also further information like your current and former names, if you had a name change, your addresses, your previous addresses, your previous employers, your current employers, and any bankruptcies or other public record information will all be found in the credit report. And we're going to talk about this down the line too, but just keep in mind that you are able to get a free copy of your credit report every year. And that's something that we definitely suggest that you do, because credit reports are something to absolutely stay on top of, because monitoring your credit report can really mitigate the damages of potential identity theft. If there's something going on that you don't know about, but somebody's opened a credit card under your name, you're going to be able to see that. Along with human error. We always want to take that into account, both human and technological errors. Things can get put on your reports that don't belong there. And if you have something that's negatively impacting your credit score that is on your credit report, you absolutely have the right to get that removed and expunged from the record and report, so you can monitor that, and staying on top of that's a great way to catch anything that's not right or negatively impacting you that shouldn't. So we always suggest to be diligent in monitoring your credit reports. So now that we've talked a little bit about the reports and what's on there, there are other things besides the report and the score that lenders are going to look at. And we like to narrow this down to the 5 C's. So the 5 C's of credit are character, capacity, capital, collateral, and conditions. So these are all things that are going to come into play when a lender is looking at your loan application, along with the report and the score. So your character, it demonstrates your financial responsibility. So how have you done in the past? They're going to look to your payment histories for that. Your capacity, what's your plan to repay the debt? So they're going to get your income and see if your debt to income is at a proper ratio for them. A lot of times it's 50%, sometimes it's less, sometimes there are exceptions. Debt to income means how much debt do you owe on a monthly basis versus how much do you make on a monthly basis. So they have the equation to figure out the ratio of how much debt do you have compared to your income. Then the capital, this is the assets you have to pay back the loan. So accounts, or anything that you have equity in. If you have equity in your home, equity in a car, anything that you own outright that you have equity in, which means you can sell it for more than what you owe. Collateral, and these are the assets that can back or act as security for the loan. So the perfect example of this is when you secure an auto loan for a car. They're going to use that car as collateral. So they're going to loan you out money that they know that's backed by that car's value. So if you stop paying, they'll take the car back. Your credit's going to get hurt, but that's that. And then conditions. So these are external factors that could affect the borrower. So a lot of times you hear terms and conditions. These are these. So what's the interest rate? What's the monthly payment? Is that going to impact your ability to pay? If the interest rate's high and it bumps up the monthly payment, that can change your debt to income ratio and make you really unable to handle that loan. So these are the 5 C's that go into the consideration from the lender's perspective. And then when we're looking at credit in general, we always want to remember that we have rights. So as a consumer, as a borrower, there are things that the credit bureaus cannot do. So you always have the right to access your reports, of course. Like I said, for free, you can do it once a year. As far as checking your credit score, there are different platforms where you can get a general idea of your score. As an example, right on our Visions mobile app, you can check your credit score from there using our FICO program that we use when we're determining if we're going to lend money or not. So that's right on our app. You can constantly monitor your score. It's not going to impact your score at all. But it's nice to have an idea, because if your score suddenly drops a lot, that can show you, well, there's probably something wrong on my report. So then you would want to order a copy of that report and monitor what's going on, see if there's something that can be taken off or something that you overlooked and can fix very simply to get that score back up. So to that, you have the right to accuracy. So like I mentioned earlier with human error, they happen. Sometimes mistakes happen on credit reports, and you have the right for that to be accurate. So if you find something that is inaccurate, you want to immediately either write a letter to the credit bureau that you found it on, whether it's Equifax, Experian, or TransUnion. Those are really the 3 big bureaus. You can write a letter to them, or you can call them or submit a complaint online and make your case for why this should be fixed on your report. and then that will be taken care of, and that'll get your score back on track. You also have the right for negative information to age off, which means that if you make a mistake in the past, or if there's a bankruptcy or you miss some payments, that doesn't haunt you for the rest of your life. So aging off, it normally takes a few years. Normally, a Chapter 7 bankruptcy will remain on your credit for 10 years, but after 10 years, it will age off. So they'll still be able to see it, but it's not going to impact your score or their decision. A lot of other negative things on your report, such as repossession. So if you had to have a car that was repossessed, that generally stays on for 7 years. So after 7 years, you have the right for that to age off. So that's not going to impact their decision making on you. So this is definitely something to look into if you do have some negative pieces on your report. Take a look at the date and see where they are and how long it will take for them to age off. They range from, for smaller things, such as inquiries. If you have a lot of inquiries in a row, those will age off after about 2 years. And then generally the bigger things are 7 bankruptcies, tend to be 10. So those are just good numbers to keep in mind in case you do have some of those on your reports. You can monitor that and see, well, when will my score get back and take that jump after they age off? And then you also have the right to privacy, of course. So really only places that are pulling your credit or have the correct authorization can really pull your credit. You can't just do that at random. So a big thing that you want to do is, there's a lot of times when you turn 18 where you just start getting credit card offers in the mail. And that can be something that is not great for you. If you're somebody that buys into the deals and opens any card that you get approved for, you can opt out from those pre-approvals. You just need to call 1-888-5-OPT-OUT. So you just want to spell opt out, OPTOUT, on your phone, and then you call them and let them know that you don't want to allow any business or organization to pre-approve you for cards. And then we got a chat here, and that is Leah putting the number in the chat. That's awesome. So that's definitely something to keep in mind, especially if you or your children are turning 18, or if you've already started getting those pre-approval letters. They can really be a pain, and they can get you into bind, because when we look at credit risks, and we're going to talk about this a little bit more, but credit card use is generally a major piece of that, because credit cards are something that they're super easy to use, and they can offer a lot of really good benefits. However, that being said, they often have a very high interest rate, and being easy to use is not always necessarily better, because you can use it mindlessly over and over and over, and before you know it, it's maxed out. And with that high interest rate, the minimum payment that you're making isn't bringing that principal down at all. You're just paying that interest on the maxed out card. So it can really get you in a position where you're spinning your wheels, and that's something that we definitely want to avoid. All right, so a little bit more about the credit score itself. Like I said, it ranges from 300 to 850. And the credit scores are estimates on how likely you are to pay back loans or services. So when your credit score gets pulled, that's just a general understanding of what their report probably looks like. If it's in, as you can see here, over 740, so they're a very dependable borrower. So their history is generally very strong. The amounts owed are generally pretty low. So they're going to be somebody that is a good bet to lend money to. Whereas if somebody had a 575, it doesn't necessarily mean that they're a bad borrower, but there are some things on the reports that would require more investigation. So your credit score is not generally going to be a make or break factor unless there is a hardline score that they require. But for certain things, it may just be a matter of, well, we need to look into this further, because there can be something on your credit report that is damaging it month over month, that really might not be that big of a deal. So we always want to look at the score and put a lot of weight in the score, but we also sometimes need to take it with a grain of salt because credit reports are going to go in much more in depth, and that's really what we want to focus on. So again, if you take nothing else away from a credit score, it is ranking how risky of a borrower you are, or how dependable of a borrower you are. So always shoot for the higher the better. So what determines our score? That's a big question that we get all the time. So when we're looking at what determines our score and what we can work on in order to raise our score, we want to know the breakdown. So the big two, first right off the bat, 35% of your credit score is made up of your payment history. So are you making that payment consistently month after month after month? If you've never missed a payment, you're in great shape there. That's 35%. 30% is the total amount owed. So of your total limit, how much of that is owed? So on credit cards, there are generally tiers that you shoot for as far as the limits. So just an example, let's say that we have a credit card with a $10,000 limit. The goal, the best case scenario goal is we want to keep that usage and amount owed under 10%. So on a $10,000 limit, we would want to keep that at or under 1,000. Next, you would want to say, try to keep it under 30 if you can. So on 10,000, that'd be 3,000. And then certainly you would want to keep it under 50%. So always want to shoot for that 10% of usage, but that goes to your total amount owed. So 30% is total amount owed. So the less you owe, the better it's looking. Next, we're getting into the smaller portions here, but it still makes a difference. 15% is the length of credit history. So this is where it gets a little bit tricky because there's not a whole lot you can do about this. So if you're new to credit and younger and new to the credit world, it's just going to take time to build that consistency and get a good length of credit history going. This is also a reason why oftentimes you don't want to apply for that many lines of credit at one time, or you want to limit, if you're in a good spot, limit how many you do apply for, because newer credit will impact that as well because they will average it out the length of your credit history. So a brand new card is going to have no length, so it's going to damage that average. Next, we're looking at 10% is new credit. So how often are you putting those inquiries in? And again, we talked about the inquiries, they'll fall off after 2 years generally. So that's something you want to keep in mind is how many open inquiries do I have? How many of these inquiries are under 2 years? If it's a high number, you're going to see that section be damaged. And then 10% is your credit mix. So that means what types of loans they are. So somebody can say, well, I have 7 open lines of credit, but if they're all credit score or if they're all credit cards, that's not a really strong mix. So the idea is to have auto loans, installment loans, which are just those term loans that you take out, personal loans, credit cards, mortgages, student loans. You want to have a healthy mix of those. You don't want to just see, well, this person only has one type of loan out there. So that makes up 10%. So really, when we're looking at repairing credit score, if credit score has been damaged in the past, we want to say try and limit the new accounts you open up. Let's get that payment history back on track. Let's make sure that we're making those payments month after month after month, because that's the biggest portion, that's 35%. And then we say, let's see how much we can pay down. We want to pay down larger chunks at a time because that 30% is the amount that you owe total. So the lower that goes, the more your credit is going to jump. So this is a big question, and on its surface, it seems obvious, but a lot of people don't realize how much credit really impacts their financial life. So why is good credit so important? So it gives you the eligibility to obtain loans and interest rates that are more favorable for you. So a lot of times in financial institutions work on a tier system. So based on your credit score, maybe there's a tier that's 740 to 799, and they're going to have a really, really good interest rate. And as it goes down and as you're perceived as a more risky borrower, your interest rate may be higher. So it shows that the tiers and levels of what the terms and conditions look like for your loan. So if you have a little bit lower of a score and are more risky of a buyer, your terms and conditions aren't going to be as favorable for you. So the higher it is, the more that they're going to work with you on getting the best rate possible. Also, employment opportunities. So I know as a personal example, when I applied to work at a financial institution, I've worked at banks before and I work at a credit union currently. They run your credit score if there's a potential for you to handle money, because your credit score is not only just how trustworthy are you with your money, it's also showing how are you with handling money. So they want to make sure that if you are working with money, that you have the general understanding of how to manage it and potentially give advice to people if they need it. So that's a big part of why good credit's important. If your credit score is really, really low, it may prevent you from getting a job handling money that you might potentially really thrive at and love. Renting an apartment and housing leases, landlords often pull credit. They are renting a house to people, so they want to know that the people that are renting their property are going to pay month after month. They want to know that they're trustworthy people to be able to make those payments. Insurance coverage as well. Again, as you're paying something month over month, those are pieces that people want to know that you can make those payments. So before insurance is going to cover you and potentially cover you for a lot of money, they want to know that you are going to consistently make those payments. And then a cell phone contract as well, same type of deal. And yes, Leah pointed out that evictions do appear on a credit score credit report, so that would fall into those extra public records that we talked about that are on those credit reports. So keep in mind that when they do pull the credit score and credit report, if you're trying to rent or lease a house or an apartment, they can potentially see that you were evicted, and then you would need to explain that in some way. So how credit scoring can help you. And we talked about some of these a little bit, but easier approval on loans. So I know that as we push through this pandemic time, we've seen a lot of digital enhancements and technological advances that have come pretty fast. And it was a thing before the pandemic and before these technological advances, but what has really been expanding is the use of automatic approvals on loans. So if you have a really, really good credit score, great credit report, and you apply for a loan, a computer would be able to approve you in a snap. Versus if you have a lower credit score, it's going to need to go through the underwriting process of people examining your credit report, your credit score, and seeing if you are somebody that they can lend to. So if you have a great credit score, it's going to make it a lot faster and a lot simpler of a process for you. Credit decisions are more fair. And that this means it doesn't necessarily mean that people that go through the underwriting process, it doesn't mean that their decisions are unfair. It just means that there are factors that they have to consider in order to make their decisions. So using credit scoring, lenders can focus only on the facts related to credit risk rather than their personal feelings. Factors like your gender and marital status and religion, they can't come into play, obviously. But the credit scoring system is just a blind computer. But lenders need to only look at what's going on, what's in front of them, whereas a computer can't be told a story. So there can be somebody, this generally comes into play for businesses, but business lending, they like to be told a story. And this is for personal as well. I worked in lending for a little bit. And when somebody told me how they could back it up, and maybe they didn't have the best credit score, but they had the plan in place that I liked, and everything looked really good outside of the score, sometimes those approvals could be made exceptions for, whereas a computer can't make exceptions. Computer decisions are very black and white. It's going to be this person had this on their report, yes. This person had that on our report, no. So there's no storytelling there, which is both more fair and a little bit different. So it's just something to keep in mind, where you don't have to go through that whole hustle and bustle if your credit score is really exceptional. Credit mistakes count for less. So that means when you do get a hard pull, when you're applying for loans, your credit score is going to drop lower on those hard inquiries than somebody who had maybe a more risky background. So if they're constantly applying for inquiries on loans, that's going to affect their score more than somebody who has solid credit and a more solid foundation. It's just going to drop less. And normally those pulls only drop about 5 to 8 points, but it's just on that scale, every little bit makes a difference. More credit is available. So as you get higher, like we were talking about those tiers earlier, the higher your credit score, the more willing institutions are going to be to lend to you. So if your credit score is exceptionally high, they're going to give you a much bigger limit. That's why credit cards have limits. So if somebody has an 800 credit score, they can have a very, very high limit on their credit card. Whereas if somebody has a 600 credit score, that limit's going to be a little bit lower. And then credit rates are lower overall. So like we talked about a little bit before, those tiers, those terms and conditions are going to vary. So again, back to the credit card, if somebody has that 800 score, their interest rate might be, let's say 15% on a credit card, or 10%. Whereas somebody with a 600, maybe they're looking more to 20% interest rate on a credit card. So actions that help your score, these are generally fairly straightforward. Once we know the basic structure of credit, you can kind of piece these together pretty easily. But actions that help your score are those on-time payments. So again, looking at 35% is that payment history. So making those payments on time is a big chunk of your score. So paying in full. So that means pay your complete balance on your card or your loan, or at least pay more than the minimum balance. So like we talked about before with the minimum balances, sometimes if you have a high interest rate, it doesn't make much progress because most of that money is going towards interest. So if you pay more than the minimum balance, more is going towards the principal, which is going to help you pay down that loan faster and improve your score by lowering that total amount owed, which makes up 30% of your score. So the use of online, this is a really, really great tool to have. So making payments online or early guarantee that they're paid on time. So if I know that I have a payment due on the 15th of every month, instead of me having to remember to write out a check or go somewhere with cash to pay on the 15th, I can set it up on my computer that it will automatically pay on the 14th or even the 15th, and just know that that payment is going to be posted every single month at the same time. Automatic payments really, really, really can save you when it comes to having to remember how many payments you have out there. And avoid closing credit cards that are in good standing. So back to what makes up our credit score, remember that 15% is the length of credit history. So avoiding closing credit cards that have a long-standing good history is going to hurt you, because that's going to cut off that long-standing length of credit history. So if you have credit cards that are in good standing, you don't have to use them, but try to avoid closing them. And then again, limit opening new accounts, because those inquiries are a factor in your credit score. So the more inquiries you build up, the more damage that does to your score. So make sure that you are keeping in mind that they fall off after 2 years. And once those 2 years are up and some of them drop off, then maybe you can start looking at opening new accounts or applying for new loans. So then we have actions that help our score. There are also actions that hurt your score. And again, once we know the basic structure of credit, these are fairly self-explanatory as well. So obviously we don't want to miss payments. A missed payment can stay on your report for a couple months, even just one, because it'll show that you were at least 30 days or under late on a payment. So that's going to be something that can be seen on your report, and it's going to impact your score. Maxing out your credit is going to hurt your score, not only because of the minimum payment issue that we ran into where we're just spinning our wheels, but also when we're looking at the amount owed. So if it's based on the percentage and you are using 100% of it, that's going to hurt your score, because we want to keep that usage lower and we want to keep our total amount owed as low as we can. And then again, closing credit cards. We talked about this in the last slide. We want to avoid closing out those long-standing healthy credit cards. Opening many accounts in a short period of time. Again, we're talking about those inquiries. We want to limit those. And then borrowing from finance companies. Those can hurt your score because generally finance companies have very, very high interest rates. So being able to pay off those loans are more and more difficult, and they can tend to pile up, and it can impact your total amount owed, especially those payday loan type of situations where the interest rates can be very, very high. I've seen some as high as 70%. So certain things, knowing what you're getting yourself into is really, really important. Everything in your financial journey comes down to do your research, do your due diligence. So before you borrow money from somewhere, make sure you fully understand the terms and conditions and what happens after that period of time where maybe they hook you in with 0% interest rate. That's one thing that happens with some of those finance companies. A lot of times it happens with credit cards. They'll hook people in with a 0% interest rate for a year. So people think, oh, this is great. They're using their card, and it gets to a point where they can't pay it all off. So that year goes up, and now they're paying a 20 to 24% interest rate. And the longer they take to pay that off, the more it's just piling up and piling up. So being smart about credit use can really, really, really save you from getting yourself in a situation where you're trying to forever dig yourself out of a hole. And then so some smart ways to build your score. So this is for anybody that's new to credit, or if there's damaged credit or just credit that you want to increase as time goes on. So secured credit cards are a great way to start your credit journey or repair potentially damaged credit. Secured credit cards work in a very interesting way. They are generally set up where you put a deposit down that goes into a locked account by the institution. So let's use an example of $500. If I were to put $500 in this secured credit card account, that's going to be locked, and they're going to give me a credit card that has a $500 limit. Now, I'm going to be able to use this just like a normal credit card. So if I keep making payments on it and I reach that 500 and I now can't pay it back, they're going to keep that deposit that I made in that locked account. That's going to be reported on my credit report, but ultimately I'm not going to forever be in debt because it was backed by that cash, by that cash account. But the positive part of this is once you build that credit history and your score gets to a point, that can evolve into a normal credit card where they're going to give you that deposit back. It's going to become an unsecured card, and you're going to be able to have that to continue building your credit up. Credit builder loans, these are offered by institutions for people that are new to credit or have previously damaged credit. These are really nice. They come with more stipulations than normal unsecured loans, but it's definitely good to look into what your institution offers as far as credit builder loans, because they really can help you out and help you get started. And then also having a cosigner with a solid history is always a positive thing to have. So if you have a family member or trusted friend that is willing to co-sign with you, that has a solid credit history and credit score, that can approve you for a loan where they are backing you to make that payment. So this helps in a couple ways. One, it helps you secure that loan by using their credit score, so you can get the loan and prove that you are trustworthy. But also a lot of times it encourages you to be more consistent and more trustworthy with that payment, because when you have a cosigner, that impacts their credit as well. So if you stop making your payments, you're not just hurting yourself, you're also hurting that person that was trustworthy enough to co-sign with you. So it's kind of a little bit of an encouragement for people to make that payment on a consistent basis, because my score is one thing, but I don't want to go damage somebody who trusted me enough to co-sign with me. So it's that encouragement that some people need. So these are great ways to check your reports. We always encourage anybody to check their reports as much as possible, monitor it, stay on top of it. You can get, like I said, one free copy from each of the 3 bureaus per year at annualcreditreport.com. These reports will not come with your score. Just as a little bit of information, you will only get the report. So that's where you can supplement that with something like our Visions app, where you can, if you're a member, you can check your credit score right on our app. And then these are the 3 main bureaus. We have Equifax, Experian, and TransUnion. You can always call them with inquiries. If you find something on your report that shouldn't be there, remember, you absolutely have the right for that to be taken care of. So you can dispute something, and once that falls off or they get that taken care of, they will communicate that with the other bureaus and get you where you need to be. And then that is it. If you guys are ever interested more about Visions or becoming a member, or just have questions in general, I'm Matt Koslowski. My information is right there. You can always shoot me an email. I'm always happy to help out whenever I can, however I can. We also offer one-on-one financial counseling. If you are in kind of a credit bind, that's where a majority of the clients I work with go. It's confidential. We go over your credit report, we go over your credit score, we go over budgeting, really anything that you need and where you feel like you might need work. That's something that I do on a very regular basis. I'm always happy to help out in any way that I can. I always like to say I'm a big part of this community. I try and do a lot of community-based things. So educating the community whenever I can is super, super important. So never hesitate to reach out. I love what I do. It's fun, and I never want anything to be boring. So if you ever want any advice, even if it's just a quick question, I'm always happy to help out. And at this time, if anybody has any questions for me, I am absolutely happy to stick around and answer them. I will stop sharing my screen and we can have a little discussion if there are any points people want to make.
Sure. So Matt, I had heard that 3 different bureaus may have slightly different information on them for the same person. Can you explain why that is?
Yes, absolutely. So when we went over the breakdown of how the FICO score goes, FICO actually has different models. They're generally not going to differ greatly, but they do differ enough where sometimes you're like, huh. So they can use different models where maybe the payment history is 30% and the total amount owed is 35%. They can determine that. And a lot of times the discrepancies in the scores, which this is the part that I see much more, is the time it takes for them to communicate with each other. So when a reporting agency reports to one of these bureaus, they generally work with one. So I believe that we work with Experian here. So it will get back to Experian. They need to communicate that with the other bureaus, but depending on how fast they do that is where the lag sometimes comes up. So if there's something negative that comes up, maybe the first one that they report to, it drops right away. But then you see that, well, my score is 750 on these 2, but 680 on this one. Why is that? And then you wait maybe a couple weeks or even a couple days, and they all kind of even out. So it just depends on what model they use and how efficiently they are at communicating with each other.
And then I had another question. But I lost it for a second. I know that you get a free annual report every year. Everyone does. But how often would you recommend someone who's just trying to build or rebuild credit to look at their credit scores?
The The credit report, I would say, so while I say you get one per year, you get one per bureau a year. So really you can get three. So that's something that you can spread out. You can do it all at once and just do it annually. But score wise, especially with all the platforms that there are now, you can be monitoring your score every day if you want. You can hop on the Visions app and look, what's it today? What's it today? What's it today? But really, it's definitely something to keep an eye on monthly, especially when you're first starting out. It's really whatever you're comfortable with. I have some people that do it quarterly, but monthly or quarterly is really the safe way to go.
Okay, and then another thing you mentioned was not closing old credit cards that are in good standing. So if you don't intend to use them, like say it was a JC card, and you don't have a JC Penney anymore, but you close out that account, you recommend just holding on to the account because it's in good standing and it increases your credit history period?
Yes, so that credit length is that 15% for our model. So having that in good standing will keep it going, where let's say I had it for 10 years. And then my other cards that I have, so we'll just stick with cards right now. All my other cards I've had for 2 years. This JC Penney one I've had for 10 years. So they're going to take the average of that, and the longer the better for that healthy credit length. So if you chop off that 10-year one, then your average automatically goes down to 2 years. So in an example where we only have 2 cards, one for 2 years, one for 10, that average is going to be 6 years. Whereas if you close out that 10-year one, you're down to 2 years. So it's not hugely detrimental, because again, it's a matter of just that waiting game to keep it up. But once you've had healthy standing for that long of an amount of time, it's kind of a why would you let that go?
Right. And then still on credit cards, because I know that's a big part of a lot of people's credit issues. Is there like a general rule for how many is a reasonable number to have? You good with just one in good standing, or is it better if you have more than one to show diversity? Or
It's pretty debatable. There are different things. I mean, the general rule of thumb is don't get out of control how many. I mean, I would rather somebody only have one than somebody have 20. If you can have a consistent amount that's safe to have, that you can use in case of an emergency, that you're using all of them, but you're also keeping your payments in line, you're really in good shape. So there's no general number. It's really a comfortability thing. Just try to stay in control of how many you have.
reasonable?
Yeah.
And then my last question was, do you recommend keeping a balance on like a credit card, or is it best to pay them in full?
So my big suggestion when people are starting out with credit, just an example, let's go back to the secured cards. I like to say, use this only to get gas and then pay it off. So my suggestion generally when people are starting off or trying to repair credit is to use that credit card like a debit card that you have to manually do. So a debit card comes straight from your account. So with a first timer credit card or a rebuilding credit card, I like to say treat this as if it's a debit card. So only use things that you have that cash on hand for, that you can pay off right away. Once you get deeper into it, they do like to see that usage. So if you're using it a couple times a month, that's great, and just paying off the balance as it goes monthly. Because really the goal is to be able to pay that balance off monthly. Using it is great. Using it shows that ability to use and repay credit, but that doesn't necessarily mean to carry a balance, which I think people often sometimes get confused with, because the goal is use it throughout the month, but before that interest rate hits, you want to pay that balance down.
Okay. Did anybody else have any questions? By the way, Matt, can you put up that last screen with the coupon code on it again?
Yes, absolutely.
So if anyone is interested in working with Visions, if you don't already, Matt does have a personalized coupon code that you can use just as a thank you.
Yep, and you can get up to $75. It's just, I think you need to sign up for e-statements and something else, but it's guaranteed 25 just to open an account if you're a new member, and then 25 for different things. One of them is I know e-statements, but you can use this right in the branch. You can use it online if you open your account online.
All right, thank you so much, Matt. If anyone has any recommendations for topics that they would like to learn more about, if there is an aspect of a topic we've already talked about that you want to go more in depth, absolutely, please contact me on Facebook through the library system, reach out to Matt, and we will coordinate something. So our plan is to do Financial Fridays probably once or twice a month. Is that right, Matt?
That's great. Yeah.
So we're definitely going to be looking for topics. Otherwise, your stuff was fun. So let us know what would be useful for you. Okay. All right. Thank you so much, Matt. We will talk soon about when our next one will be and what our topic will be. And
Great.
thank you so much for attending. I will post the video on Facebook for those that were not able to attend with us live today. Okay.
Thank you so much for having me.
All right. Thanks, Matt.
Bye-bye.